Imagine I handed you 500,000 today and told you to invest it. What would you do? Most beginners panic at this question because they think investing is complicated, risky, or only for people in suits on Wall Street. But here's the truth. The difference between growing that 100,000 into something life-changing and losing it all comes down to a few simple principles. And to prove it, I gave 1,000 to a complete beginner, and what happened might just change the way you think about money forever. When most people think about investing, they imagine they need a huge sum of money to even get started. They picture wealthy businessmen with massive portfolios, multiple properties, and complicated spreadsheets. But the truth is, the smartest investors know that starting small is not only possible, it's often the best way to learn. That 20,000 isn't just cash. It's a seed. And like any seed, it can grow into something much bigger if you plant it properly and give it time. Starting small takes away the fear of losing big. Think about it. If someone threw their entire life savings into the stock market without knowing what they were doing, the stress alone would keep them up at night. But when you begin with a modest amount, you give yourself permission to make mistakes without it costing you everything. You can afford to stumble, learn, and adjust while still being in the game. And that's how every seasoned investor got their start. They made mistakes, but they made them on small amounts. Here's another important point. Starting small gives you the experience that books and YouTube videos can't. You can read about investing all day long. 8. But when it's your money in the market, your mindset changes. Suddenly, the daily ups and downs of the stock chart matter more, and you realize how emotions like fear and greed can influence your decisions. That 100,000 acts as your training ground. It's not about how much you make on the first try, but how much you learn from the process. Let's say you take that 1,000 and invest in a low-cost index fund. Maybe in the first week, the market dips and you see your balance drop to 950. A beginner might panic and think, I've lost money, this doesn't work. But by starting small, you learn an essential truth. Temporary drops don't matter in the grand scheme of things. If you hold steady and zoom out over months or years, the market trends upward. 8. That little dip becomes a lesson in patience instead of a financial disaster. Starting with a smaller amount also builds the discipline you'll need later. It's easy to dream about investing when you think of doubling your money, but the reality is far less exciting at first. Maybe your 1,000 grows to 150 after a few months. Some people would shrug and say, that's it. But if you've built the habit of consistently investing, even small amounts, you'll realize that those small wins add up. 8. That 50 gain represents money that worked for you while you slept, and the more you invest over time, the faster those gains compound. Think of it like going to the gym. You don't walk in on the first day and expect to lift 200 pounds. You start lighter, get used to the movements, build your form, and gradually increase the weight. Investing works the same way. That 1,000 is your lightweight training session. You build your financial muscles, your discipline, and your confidence. Then, when you have 10,000 or 100,000 later, you'll be strong enough to handle it without making reckless mistakes. Another benefit of starting small is that it lowers the barrier to entry. The 48. Too many beginners talk themselves out of investing because they think it's only for people with huge amounts of money. But by showing yourself that even a modest 4,000 can be invested, you break down that mental barrier. You prove to yourself that you don't need to wait until you're rich. You need to start with what you have. And once you take that first step, the journey becomes less intimidating. So when I gave a beginner investor 1,000, the goal wasn't for her to turn into a millionaire overnight. The goal was to show her that the act of starting, no matter how small, is the key. That 1,000 represented possibility. It was the doorway to experience, discipline, kite, and confidence, the 3 things every investor needs more than money itself. Because once you build those qualities, scaling up is easy. The hardest part is just getting started. Once you understand that starting small is possible, the next step is learning where to actually put your money. And this is where most beginners get it wrong. They hear about a hot stock tip from a friend, or they see some flashy ad about crypto promising overnight riches, and they think that's the path. But that's gambling, not investing. The 48. The real power comes from picking the right investment vehicle, the place where your money can grow steadily with the least amount of risk. For a beginner, the safest and smartest option is usually something simple like a low-cost index fund or an ETF. These funds spread your $1,000 across hundreds of companies at once, which means you're not putting all your eggs in one basket. Think of it like buying a slice of the entire market instead of betting on one company to win. If one company struggles, it barely dents your overall investment because you've got exposure to dozens or even hundreds of others. That's diversification. 8. And it's your best friend when you're starting out. Let's imagine you took that $1,000 and put it into a single company. If that company has a bad quarter, your money could drop by 30% overnight. That's a scary hit for anyone, but especially for a beginner who hasn't built the patience or confidence yet. On the other hand, if you put that same $1,000 into an S&P 500 index fund, you're investing in the top 500 companies in America all at once. If one company stumbles, 499 others are still working for you. That stability gives you the ability to sleep at night, and it teaches you how to ride the ups and downs without panicking. Another benefit of picking the right vehicle is cost. Many beginners don't realize how much fees can eat away at their returns. If you're paying 1% or 2% in fees every year, that doesn't sound like much, but over decades, it can add up to thousands of dollars lost. That's why low-cost index funds or ETFs are so powerful. They charge a fraction of what traditional funds do, yet they often outperform them. By keeping costs low, you're putting more money back into your pocket where it belongs. 48. And here's where beginners often make another mistake. They think they have to constantly check their investments or trade in and out to make money. But the right vehicle doesn't need that. It doesn't demand you sit in front of a screen for hours trying to guess what's going up or down. Instead, 8, it quietly works in the background while you focus on your job, your business, or your life. That's the beauty of it. It turns investing from a stressful game of chance into a steady, long-term strategy. Choosing the right vehicle also gives you flexibility as you grow. That ones and zeros and might not feel like much at first, but if you add to it every month, it compounds into something much bigger. With an index fund or ETF, every new contribution buys you more slices of the market. You're building ownership in hundreds of companies, which means you're tying your future to the long-term growth of the economy itself. History shows that over time, economies expand, businesses grow, and markets trend upward. By being in the right vehicle, you're riding that wave instead of fighting it. And here's a final point. 8. Picking the right vehicle builds confidence. When beginners see their money working consistently, even with small gains, it changes how they view investing. They stop chasing shortcuts because they realize steady growth beats risky bets. That confidence is priceless. It transforms a nervous beginner into someone who can calmly watch their money grow year after year without feeling the need to gamble on every new trend. So when I handed $4,000 to a beginner, the lesson wasn't just go invest. It was go invest in the right place. Because if you get the vehicle wrong, the whole journey feels rocky and uncertain. But when you get it right, everything becomes smoother. You're no longer stressed about every dip. 8, you're no longer tempted by every fad, and you're building a foundation that can carry you for the rest of your life. 8, one of the biggest traps beginners fall into is believing they need to time the market to make money. They think they have to predict when stocks will rise or fall, jump in at the lowest point and sell at the highest. But here's the truth. Even professional traders with years of experience struggle to do that consistently. For most beginners, trying to time the market is a fast track to stress and disappointment. What actually works and what has built wealth for generations is simply spending time in the market and letting compounding do the heavy lifting. Let's break this down with that funds and as an example. Suppose you invest it today into a broad index fund and just leave it alone. Over the short term, the market might bounce around. 1 week you're up 30A, the next week you're down 4D. But zoom out and you'll see that historically, the market has grown by about 7 to 10% per year on average. That means if you just let your money sit and grow, it has the potential to double every 7-10 years without you doing anything fancy. All you have to do is stay invested. Now, compare that to someone who tries to time the market. They see prices dip and panic sell, then try to jump back in when things look good again. The problem is that markets move fast. Often, by the time they feel comfortable buying again, the price has already gone up. They end up buying high and selling low, the exact opposite of what they wanted. Studies have shown that if you miss just a handful of the market's best days over a 10 or 20-year period, your returns are cut in half. And do you know when those best days usually happen? Right after the worst days. So if you sell during a crash, you're almost guaranteed to miss the rebound. This is why patience beats prediction. Time in the market allows you to capture both the ups and the downs. And it's that consistency that grows your wealth. Your Zalosen doesn't need perfect timing. It needs discipline. Think of it like planting a tree. If you dig it up every few weeks to check the roots, it will never grow. 8. But if you water it, give it sunlight and leave it alone, one day you'll be sitting in the shade it provides. There's also the magic of compounding, which only works if you give it enough time. Compounding means your money earns returns, and then those returns start earning returns themselves. In the beginning, it looks slow. Maybe your 1,000 grows to 1,050 after a year, not that exciting. But after a decade, that same 1,000 could be worth around 2,000. And if you keep adding to it regularly, the growth accelerates. Time is what turns small, steady investments into serious wealth. Another way to think about it is emotional freedom. When you stop trying to time the market, you stop stressing over every headline and every dip. You don't have to watch the news every night wondering if you should buy or sell. Instead, you trust the process. You know that markets rise and fall, but over the long run, they climb. That peace of mind is priceless, and it keeps you from making impulsive mistakes. So when I gave that beginner Zalosen, the lesson wasn't about chasing quick wins. It was about staying consistent by keeping her money in the market instead of trying to time every move. The 48. She learned that investing isn't about getting rich overnight. It's about getting rich over time. The people who win aren't the ones who predict the market perfectly. They're the ones who stay in the game long enough to let the market work for them. Mindset also matters when it comes to patience. Investing can feel slow at first. You put in 1,000 and after a year, maybe you've earned 7D or bought AD. That doesn't feel like much compared to the stories you hear online about people turning tiny amounts into millions overnight. But the people who build lasting wealth are the ones who stick with it, keep adding over time, and let compounding do its work. The beginner with the right mindset looks at that 70 again and thinks, great, this is proof it works. Then they keep going. Another part of mindset is discipline. It's easy to say you'll invest regularly, but life has a way of tempting you with other expenses. A new phone, a night out, or a fancy holiday can all seem more exciting than putting money into the market. But the disciplined investor knows that every dollar invested today is worth far more in the future. They choose delayed gratification because they understand the long-term payoff. That discipline is what turns average earners into wealthy individuals. Confidence is also shaped by mindset. In the beginning, it's natural to feel nervous. After all, you're putting your hard-earned money at risk. But as you develop the right mindset, you stop seeing investing as a gamble and start seeing it as a system. You trust that the market has always trended upward over time. You believe in your ability to stick to a plan, and with every small win, your confidence grows, making you less likely to make rash decisions when challenges arise. Finally, mindset determines whether you see investing as a one-time experiment or a lifelong habit. The beginner who sees that $4 as just a test run may stop after one try. But the beginner with the right mindset sees it as the start of a journey. They keep adding, they keep learning, and they keep building. And over the years, that attitude transforms small beginnings into financial freedom. So when I gave a beginner $1,000, the lesson wasn't just about money, it was about mindset. Because the truth is, money without the right mindset will always slip through your fingers. But even a small amount, when combined with discipline, patience, and consistency, can grow into something extraordinary. The numbers matter, but the mindset is what makes the numbers work in your favor.